Hey, everybody. Welcome back to the 2x2 for Independent Consultants. Today, I am joined by Lorie Jones. She is the founder, owner, and key advisor at Fearless Financial Advisors. She's also the podcast host of Fearless Females, which is an excellent resource that I'd recommend for any women and their allies who are thinking about starting their own business, running their own business in the midst of it. You are not alone. She's interviewed some really amazing people that I've gotten a lot out of. And so I am really happy to be joined with you today, Lorie. Thanks for coming on.
Well, thanks for having me. I'm super excited to do this.
So there's a moment that I've noticed, and we've done almost 100 interviews with fractional executives, independent consultants, senior advisors, business owners. And there is a moment that successful people come to where making money actually starts to cause confusion and cause problems. And I know that that feels a little counterintuitive to people who perhaps aren't nodding their heads with me right now. But I have a saying that I've kind of lived my life by now for about 15 years, which is more toilets, more problems. And what I mean by that is it's seemingly really exciting to be in a position to be blessed and lucky enough to buy things, bigger houses, second houses, boats, RVs, all of those things, though, they come with toilets. And not to get crass, but toilets require maintenance. And so it's a good analogy because if you've ever been in a situation where you have, the number of toilets is, and the maintenance you have to do on them is really it's a good analogy for how much complexity having things and having money can cause for many people who grow a successful business. So this is kind of a new thing and a new phase for them. And despite their success, money is not, and managing it and working within the tax system and the investment system isn't something that everyone learns. And so that is when someone like you comes into the picture to help and add some clarity here. So thanks for joining me today.
Yeah, no problem. This is my wheelhouse. It's my favorite thing. I love that complexity that comes with success. And I do realize that there are people that it's more toilets, more problems. I actually think I had a client once who had several different houses, and hers was the air conditioner. Like the air conditioning units kept going out at all the different houses, and she had probably 4 air conditioning units to deal with in 1 year. And I'm like, oh my good heavens.
Yeah, I mean, it's a real thing. It's a real thing. Yeah, maybe that's less crass, but it's easy to picture more toilets. So more toilets, more problems. So I was thinking about this, the kind of the questions that I get and the patterns that I've seen. And for me, it feels like there's kind of 3 stages of business that someone walks through. And there's a 4th, which we're probably not going to talk much about today. But stage 1 is kind of getting up and running and feeling like you've built some financial momentum enough to keep going to the next step. Stage 2 is you're building, growing. You feel like you're starting to get repeatable. You feel like this is a long-term play. And then stage 3 is, okay, wow, I think I've met a point where, this is going pretty well. And now we've got some of that complexity. I'll say stage 4 is maybe, let's say it's the exit of that business or the IPO or some major event where you're going to have a pretty large sum come into the picture. We're going to focus on these first 3 stages today. And the questions people ask around risk management, taxes, payroll, legal entities, all of those things change at each one of the steps. So I thought what we could do is walk through each of these steps. I'll ask some questions that have been asked of me, and then we will listen to your sage advice.
Sure. I love that. That sounds great.
Okay, cool. So first stage is getting set up. So for question I get here, most common question is, do I need an LLC? Let's just start with that basic question. So does someone need an LLC?
Yes. And I just ran into a problem yesterday with a client that I was meeting with where she had been running a very successful business for a long time and didn't feel it was necessary to set up an LLC. And I just wanted to cry for her. An LLC is your protection. As a sole owner doing business under your social security number in today's litigious society, it could expose not only your business, but your personal self, your home, your college tuition for your kids, your IRAs. Exposes them to court cases and things like that. And so we We want to get that business set up as an LLC. First thing to sort of put that veil between your business and your life. So it can't get through. And then we want to kind of keep it separate too. I think it's important to not only set up the entity, but to actually treat it like a business. You have a bank account that you use just for business expenses. Makes it easier at tax time too, but it also creates that barrier between yourself and your own, your home, your car, your personal stuff and the business. If someone comes, today's society is really litigious. So even as much as like giving advice over the telephone on, I don't know, on vacations or something like that, they could come back and, I mean, they sue you if their coffee's too hot or something like that. Like, so you need to protect yourself. And that is the one thing I talk to my new entrepreneurs about. Very first thing is please make sure that separation is there. Make sure that you've set up your LLC. It's so easy. It's not hard at all.
This is a myth. Let's bust this myth. People think it's hard. They ask a lot of questions. They get overwhelmed. Not hard.
Not hard. It took, when I decided I wanted to set up a business 10 or 15 years ago, my husband went on, had it set up within 15 minutes, and we paid our, $75 fee, and we were business owners. You have to make sure and re-register on a yearly basis and stuff like that. But it is so easy.
It's so easy. Let's break this down in two ways. So what state do you live in?
I'm in Colorado.
You're in Colorado. Okay, so I'm in Texas. I think there are some states where this is as easy as you and I are describing it. In Texas, Google it. It's create a login, create on the Secretary of State's website, sign up, a couple $100, you're in business. You file a no revenue form once a year in May, unless you've made over like 2.6 million in taxes or something. Like, it's very simple. It's not always simple in every state. But there is a simple workaround. Do you recommend registered agents?
Registered agents to help you get registered in the state?
Mm-hmm.
Yeah. I mean, it's obviously takes some of the complexity out of things and helps you to get that simple answer. And 100%, if you can make it easier on yourself and still get the protection that is just necessary in my.
One of the things that I've noticed, I don't know if this existed when I set mine up over a decade ago, but this is not a recommendation for Northwest Registered Agent. There are many, but Northwest Registered Agent is a nationwide company. They will set up an LLC for you, regardless of what state you live in. And then for a fairly nominal fee, they'll file all the state required reporting. So you really never have to worry about it.
Yeah. Yeah. And the thing is like, as business owners, we are willing to pay money for like bookkeepers, or I find this funny that you're willing to pay money to get your online presence taken care of and like have someone post for you on Facebook or LinkedIn or something like that. But you're not willing to pay money to set up the most important business document that you have, which is, get your LLC set up. And if you just don't want to deal with it, yes, go to someone who does deal with this for a living, because it's like the number one thing I would say.
Yeah. So steps: set up the LLC. And then you mentioned the importance of separating banking.
Mm-hmm.
How simple is that?
Well, it's easy. Any bank will give you a corporate account, and you can get a tax ID number on your corporation. Again, this is like it's like a 15-30 minute process. It really isn't hard. You can get usually a credit card on that account, and then you set up all your bills separate from your business than from your regular, your regular operating expenses. And it puts that corporate veil between what you're doing as a business and protects your personal assets and stuff like that. So it's really easy. And again, there's a lot of questions like when you set up a business, people think, and it is hard. It is hard. It's a lot of work. It's a lot of anguish. It's a lot of like, should I do this or what should I do? And you think all these decisions are life or death, but the actual setting up of the business and the setting up of the bank account and the getting the QuickBooks, like you can get that so easy. And if you just don't want to deal with it, pay somebody to do it.
Yeah.
100%.
Yeah. It's like the bank may require you to come in and sign something, and maybe that's the thing you just never end up, just freaking do it. Like go and get it done, block a day, and then you're up and running.
Well, I don't know if you've ever listened to Mel Robbins, but she's got this 5, 4, 3, 2, 1, and then like you like get up and do it. So there you go. If it's hard, do it.
Yeah, there
5,
you
4,
go.
3, 2, 1, and get up and do it.
So bank account, and then you recommend just for bookkeeping, just basic QuickBooks.
Yeah, QuickBooks is the easiest, most comprehensive across all. You can, I know several different bookkeepers that will get you started and kind of, you pay them a fee, but they'll get you started and kind of doing it on your own so that you're set up right. And if you don't have the money to pay a bookkeeper on an ongoing basis, but you just want to make sure that things are set up correctly, like do that. Just have them set you up and get you started in the right direction, and then you can go until you can afford. Um, and bookkeeping is one of those things that I don't think many of us business owners have a business like we're not in the business of bookkeeping. So it's one of the first things I'd suggest offloading if you can.
So I have a slightly contrarian take on bookkeeping.
Okay.
So number one, I would say you must get an LLC. You must set up a separate bank account. You must link that bank account to QuickBooks. I'm okay that if you ignore it for a year.
Uh-huh.
The important piece is that you have the ability to go and pull the reports and see things, but you have at least you have the tracking in place. 1 year of business, someone can come in and clean that up before tax time, right? It's
Oh yeah.
not something you would have to do. In my opinion, that's a can you can kick down the road.
Yeah, you can. I think that's where I'm recommending like maybe check in quarterly. Like maybe not let it go for a whole year.
Listen to the financial advice, not the strategy advice here. Just let that shit go.
But if you have someone set you up so that you understand like the different accounts, the chart of accounts, how to put your expenses in there, how to automatically connect it to your bank account and stuff like that. So it kind of goes on its own. And there's AI agents that'll do this for you too. There's at least 3 that I know of, and I can't think of the names off the top of my head, but 3 of them that will be your bookkeeper, your virtual bookkeepers. You don't have to pay anyone or do it
Maybe we'll get that for
yourself.
you and put it in the show notes. That would be, I
Yeah.
think, a really useful tool. What we do, and so this is not for stage one. You probably could do this. You're going to have a low credit limit. We use Ramp, and so
Mhm.
Ramp is a credit card. It's a lot of things now. It's a whole financial management platform for payables and credit card. But what it has and why we started using it was it has a 99% success rate at QuickBooks matching. So once we
Mhm.
implemented that, like we really don't need we probably should have a bookkeeper once a quarter. We have one probably every 5 months. It's just a kind of a different situation. But we really like Ramp does all the credit card. And if I put everything on that credit card and my team all has that credit card, we're really, and all of our payables run through that credit card. Like the exceptions in QuickBooks are so minimal that it's
Mhm.
taken that lift out of the business completely.
Yeah. Yeah, and that's what the AI
It
agents do
has,
kind
yeah,
of
it
is
does it
their
through AI cash application. So
yeah, yeah.
yeah, it works great. I think it's the ramp solution is really designed for what we'll talk through in stage three. But as long as you have an LLC and a bank account, they will set up an account for you. So, as a-
100%. And those are the important things to do at the beginning. Then you can concentrate on growing your business and getting some actual revenue in the door and stuff like that, rather than, worrying about the nitty-gritty of a whole bunch of the little nitpicky things. You don't have to be perfect. You do have to set up the LLC and make sure that you've got your bank account, make sure that you're protecting yourself.
you heard that, go do it if you haven't. I have a question for you. When do you start paying yourself via payroll? And can you describe the difference between payroll and a distribution?
Yeah. So this is a question like an LLC designating yourself as an S corp. So a lot of times, like during that first stage, you can just take distributions out of the business. You don't have to elect an S corp status, and you don't have to actually do a payroll. But the difference is that you're going to pay those self-employment taxes on everything, right? As opposed to once you elect that S corp status, then you don't have to pay the self-employment taxes on the distributions as opposed to the payroll, the W-2 income that you have.
Let's do some basic definitions here first for those of us who are totally new. So what is an S corp? How is it different than an LLC?
So an S corp is just a tax designation. So you can be an LLC, you can be taxed as a partnership, a sole corp, a sole proprietorship, or like an S corp. And the S corp taxation is just, it's a way that you're taxed on the earnings in your business and your LLC. And if you come on and you were just a sole proprietor or just one person doing business, using your LLC, everything that you make is taxed, as you make it. So there's no money that it doesn't go through that 7.5%. You have to pay your own self-employment tax. So you have to pay that 7.5% portion that your company would normally pay. If I go get a job at somewhere that pays me income, they pay that 7.5%. But if I am my own business, I'm paying that 7.5%. If you are a sole proprietorship, you end up paying that 7.5% on everything.
You pay the 7.5% as the employer plus the 7.5% as the employees. So you're paying 15.5% payroll tax, and then on 100% of the dollars you make.
Yeah, 100%. Exactly. If you elect an S corp, what you're saying is uh, it makes sense, and it really is kind of an it depends sort of answer on this, but it might make sense around 75,000 to 100,000 in actual profit, right? And you say, well, I can take and pay myself a reasonable income. And that's the stage you have to be at where your income isn't, in and out. You're not making nothing one month and everything the next month. You've got a pretty steady, reasonable income where you can pay yourself a salary. And the salary has to be reasonable. It can't be like, we've had to talk to dentists and doctors who are paying themselves like, 50,000 a year, 25,000 a year. Like, that's not quite a reasonable salary.
Well, okay, so let's pause for a sec, because you've said a couple of really important things here. Number one, when do you take an S corp election? Lorie's answer is between $75,000 to $100,000. You said profit or revenue?
So after all your expenses are paid, you're making
your business expenses, then your cost of goods sold or your contractor fees, what have you. That is the amount at which you then elect. I'll just interject here. Electing it is so easy. You Google it. There's a form on the IRS that I believe you still print and sign and mail. And that is that. They will send you a letter and you keep that letter forever. And now you are an S corp. Very simple. Then you mentioned this idea of a reasonable salary. So this is an important one for consultants, because there's a really wide range of what, and not what is reasonable, but of what is actually happening. I know consultants that make $50 an hour. I know consultants that make $1,500 an hour. What do we do here? What do we think is how will reasonable be judged, or how should we think through this?
Yeah, I think that you have to look at what others are making doing a similar job, right? And you have to, again, with the example of the doctors or the dentists, like a reasonable salary for a dentist is not really $25,000 a year. Actually, that's not a reasonable salary for just about anyone that I can think of. So I think that you have to kind of look at comps. I am not a tax professional, so we definitely would have to talk to one of them to kind of get the ins and outs and the details and the nitty gritty of what is and isn't allowed, because I can't speak to that. But what I can say is that you should be looking at what your profession should be making, and you have to justify the reasonableness of your salary.
I have looked at this in two ways. So one is that way. The other, and we'll get to this in stage two, around when I set up a SEP IRA many years ago, the way that I understand it works is that you can contribute up to a maximum amount every year. That is a little bit, now I think it's like 270. No, it's like $70,000 a year. Okay, let's just call it 70 for argument's sake. You can contribute up to $70,000 a year. That is then categorized as an expense to the business. So it comes out of your expenses, lowers your tax base, but that $70,000 must be 25% of the salary or the wage you pay yourself W-2.
Yeah, yes, but you don't have to wait until you're at that level
No,
to
you
be.
don't have to. That's the max case.
Yeah,
So what that means
yeah,
is that you as a consultant could pay yourself 260 something $1,000 a year if that, and that would, is that deemed reasonable? Or you could choose to pay yourself less. And but that was the calculation kind of I did in my head was like, well, what do I do this year? And then what do I want to save as a tax expense? And then how do I set my salary such that I'm actually backing into my salary from what I wanted to put into my SEP based on our
you could
performance that year.
maximize. Yeah,
Yeah.
yeah, yeah, exactly. And again, we'll probably talk about this a little bit in stage 2, but they've made some really great changes in solo 401ks, and the SEP is kind of yesterday's news, and the solo 401k is a really
All right,
great
we're gonna get
option.
there. We're gonna get there. I have employees now, so I don't get to do any of this stuff anymore. It was actually a big
Yeah,
bummer for me. Sarah, I hope you're
yeah.
not listening. But I was like, oh, do I really want to do this? Like, gosh, like it's a really amazing
Yeah.
benefit. So stage 1, yes, you should pay yourself payroll, is Lori's opinion. Okay, great. Let's move to stage 2. Stage 2 is when you have early traction. Or do you think about this as like that 75 to $100,000 point, or do you think it's earlier than that?
No, I think that this is about I kind of think of stage 2 as sort of when you're making enough money to support yourself plus. So, yeah, about 100,000 is a reasonable amount for about
So this is
this
about
stage.
the time when you are questioning if you should leave your day job.
Yeah, or you have left your day job. You are starting to make, like, I know lots of people that start that entrepreneurship and they're not making anything for the first little while. This is when they start, like, being glad they left their day job. How about that?
That happy moment, I'm following you. Great. And we're thinking about the S corp in this time period. What other tax because this is where tax starts to matter. What other tax considerations? No, you're not a tax specialist, but just thinking like what should a business owner be thinking about?
Yeah, this is a stage where I really like to set them up for success, because most of the time they're stage 1, they're sort of like, they're just putting everything they can back into the business, time and money. And they're not considering, hey, I quit my W-2 job to take on this business responsibility. That also means that I have put off saving for retirement,
Mhm.
saving for my future. I have put off this stuff. And I'm like, I'm just, swimming to survive. I'm just trying to get through this first stage. But the second stage is the point, probably earlier than you'd like to, but you really need to start thinking about your future. You did not start this business so that you could work for nothing. And you are working for building a better future for yourself. So starting your 401ks at this point is such a good idea. And that coincidentally coincides really well with your tax planning, like making sure that the S corp election at this point is a valid consideration, and does that make sense, and it doesn't make sense for my business. And rather than putting everything you have back into your business, this is the time when you need to start thinking about, what do I want this to provide for me long term? Like, should I be growing my savings inside of the business to cover any shocks that come along from the system? And I need to be starting my long-term savings for retirement.
Yeah. This is great advice. So 3, let's just call it 3. I might ask you about a fourth. I heard you say 1 is the S corp. Second is we'll call it retirement. We'll come back to what different vehicles you have there because we have the solo 401k, but I know you've mentioned the Roth to me as well. Talk about how they're different and what that does. And then we've got savings inside the business. I also want to ask you about healthcare. Is that a consideration at this point? I mean, I'm sure it is, right? And this is an area I frankly don't understand. So I may ask some kind of stupid questions there too. But what are the retirement options that a solo owner or consultant would have?
I love this for them. So I'm going to give you my order in order of the favorites. And always, it depends on your specific financial decision. Always talk to a financial advisor and make sure that the financial advisor you're talking to understands retirement planning, solo 401k, SEP, simple IRAs, because a lot of regular financial advisors actually don't have a lot of experience in this space. So I just took over a plan for a company that had been doing it wrong for a year and a half. And it was a snarled kind of mess that we've had to make right. And you don't want to get yourself in that situation. So I would say that the solo 401k is my very favorite vehicle. They have recently come out with a Roth portion of the solo 401k. So recently, within the last several years. So you can set up, as long as you don't have any employees. So it just needs to be, it can be you and a spouse in your business, but you can't have any W-2 employees. And you can contribute up to 20 to 30,000. And I'm not going to give you the exact numbers because they change every year because of the inflation, and the government gives you a new limit. But I think it's around 23,000 for those under 50, 20 or 30,000 for those. I think it's 30,500 for those over 50. And then you've got an extra $2,000 catch up if you're over 60 something. And so that is your employee contribution. You can put that in either pre-tax or Roth, depending on whether you're trying to save money on taxes or whether you're trying to maximize that after tax savings, which is a super good benefit because a lot of times in this stage, you're making too much to make a direct Roth IRA contribution. So this gives you the opportunity to put some money into Roth if you want to. You can do half and half. Like there are no rules here. Like, the rule is you can only contribute this amount, but within that amount, you can choose whether or not you want to do it pre-tax or Roth. You can set your spouse up with a salary, have them have a solo 401k account, both Roth and pre-tax. And on top of that employee contribution, you can do an employer contribution or profit sharing contribution. And that's where you were talking about with the SEP IRA, where the total amount contributed can't be over 70,000. It can't be over, depending on your salary and stuff like that, 20 to 25% of your income, depending on like how you're registered. And your accountant helps out with that. So he can do those calculations for you. But that money, again, comes straight out without the self-employment taxes.
And are there self-directed options for this, meaning you can choose where to invest your own money?
So I don't deal with the self-directed case, but they have, because of the new rules that just came out with I think it was the Big Beautiful Bill Act, where they said that you can invest in like land inside of the 401k. Yes, they do have options for self-directed 401ks. I actually would suggest that unless you are very financially savvy, that you just talk to a financial
We've got a
advisor. And
segment of this audience we're a lot of MBAs. So there's a lot of
yeah,
people who are running a second business, or they are really in tune with the markets. They have big financial background. And the idea of a targeted fund is like, what's the freaking, like they're beating the market anyway. So
right, right, right.
I found this to be a big benefit for myself, was that all of a sudden I went from a W-2 job with a targeted fund to Lauren, and I got to make decisions. And over 10 years, that has been a big win versus being
Yeah,
tied to a company plan.
yeah. Well, and with the solo 401k, like you do have a lot more options just within the investment sphere because yes, you don't have to do the target date retirement series or anything like that. Like you have the entire broad outlook of the financial markets. So you can invest in, direct stock, or you can invest in whatever. But the self-directed 401k, that's more for like investing in real
In
estate
real estate,
direct.
yeah.
So that's it's a whole nother level where I 100% am saying yes, the solo 401k that you are like putting in your own investment choices, or you have a financial advisor like me that's helping you out if you don't do those investments yourself. Absolutely 100% great. Fidelity has a good Schwab has a good platform. They all have good options there, but the self-directed is another option entirely, and that requires just a little bit greater
Yeah.
level of comfort.
I'm going to go back to a basic question. What's a really easy way for someone to think about the benefits of standard 401k versus a Roth?
So, K now a standard 401k actually includes the Roth. So it is kind of standard now. You've got both options, both Roth and 401k, even for solo, everywhere you go. Pretty much every company will allow the Roth option. Now, when I suggest you use the Roth is if you are younger, and by younger, I honestly mean anyone like younger than 50. Yeah, because you've got so many years for that to grow and double and triple and, so on and so forth and you are in charge. You've got control right now over what your tax bracket is. Whereas in the future, you don't know if they're going to raise taxes. I mean, back in the 80s, they were up at like 50, 70% tax rate. It was insane. And that you don't know if they're coming back with those sorts of rules. So that's why I would say if you're younger than 30, if your
Yeah. Looking
pocketbook can
back, that
handle
would have
it,
been a great decision.
yeah, I would suggest almost everything into Roth. If you're between 30 and 50, really think there needs to be some portion of your 401k that you're putting into Roth. And I would even say after 50, 50 to 65, you'd have a hard sell on me not making sure that you had at least a portion of that in a Roth bucket. You're not like today's Lauren is not going to say, "Oh, Lorie, this was the best thing ever," because tax day comes and you're going to be like, "Lorie, you made me pay more taxes." But as future Lauren comes along, you retire with a pocket of money that you can um, use tax free in the Roth vehicle, you're going to be like, "Oh my gosh, I'm so glad I did
So
this."
let's go back. So just to make sure that someone who's listening to this, let's say you don't know it. A Roth is post-tax, meaning you pay the taxes, then you put the money into the account. And then as it grows, you can take the money out when you're older without paying taxes, right?
Mhm. Yeah, it's
Whereas
tax free.
tax free in the future. Whereas the standard method would be to put pre tax dollars into the account, which ostensibly is more dollar in the year you put it in. But when
Mhm.
it comes out, will you pay? I should know the answer to this. You will pay tax on it, but will you pay your nominal income tax rate or will you pay capital gains?
No, not capital
You'll
gains.
pay your
It's
nominal rate.
ordinary.
Yeah, that's bad. I mean, like, especially if you're coming out and you have a whole bunch of stock options or you've put a lot of money away, you could still be in a high tax bracket on,
Yeah, you
yeah.
could. Yeah, it could significantly change. And that's what your Medicare is based on. You could push yourself up into those higher tax brackets during retirement. And that's where a financial advisor comes in handy because the only time that I would say that you're better off putting all of your money in pre-tax rather than having at least a portion of it go in Roth is if you are older, 60, 65, and you have zero money saved for retirement. So you are more than likely going to end up in a lower tax bracket during retirement because you just don't have anything saved. And it does happen, but that's the only time that I would say, okay, I can see a use case for putting 100% of it in
So a
pre-tax.
100 pennies episode, you have 100 pennies and you're going to allocate them between the Roth and the standard. Let's say you have a bad year in business. Is that a year where you make a different choice? Like, let's say you're not going to pay taxes anyway. Like, you're going to have a loss. What
Yeah.
is that making? Yeah. Would you make a different choice in that year or does it matter?
Yeah, no, it does. It does matter. So if you are having a really low earning year, you still have to get your W 2 income. You can only make these employee contributions out of your W 2 income. So as long as you have some income, but say your family, and they're not just going to look at your income if you're in a family situation.
Mhm.
If you're joint filing together, you've got to look at both of your incomes. But if you're having a down year and you've dropped into the 22%, 17% tax bracket. Like, yeah, put it in Roth.
Okay. And conversely, if you, let's say you have a windfall, example of, let's say the spouse is part of a IPO as a, one of the first 100 at a company and you got a big year, is it as easy as to say you just do the opposite or are there other things to consider?
Yeah, I would definitely put as much into pre-tax as you can. And then there are other options. You can add a cash balance plan on top of your 401k plan. And on those windfall years, there are rules around it and the costs are a little bit more. So you want to make sure and think through that carefully. And I would suggest a financial advisor at that point.
It'll be complicated. Yeah.
Yeah, you get complicated, but you can put even more than that away in those windfall years in your business and save yourself, your family quite a bit
Thanks
on
for answering
tax.
those questions. I have an ulterior motive here, which is I just want people to understand that you're surfing when you run a business. Not every year is big waves. Some years are hurricanes and some years are not. And that it is really important that you think about the tax implications of how you use your money, regardless, every year differently, regardless of if the year was bad or good. There are circumstances, and what happens in regulation and in taxation changes all the time. Like, it's very difficult to keep on top of this. Like I said, more toilets, more problems, right?
Yeah, and I think it's really important to understand that, like, these are basic guidelines, and ideas, but I don't know your specific situation, and it's important to talk to someone who is really aware of your specific situation.
I want to ask a question about if this is so I see a lot of this tip online, and I don't know if this is smart or not smart. Pay your kids to save, to make their salary come out of be an expense for you and thus lower your tax base. Good idea or bad idea?
Yeah. Um, Generally, if the kids are in a lower tax bracket, like, it's not the worst idea. It's actually a pretty decent idea. Now, you have to be really careful because the kids actually have to have a job description. They actually have to be doing work. And the other thing is that if you're paying your kids a W-2 income, you are not you're not considered, you can't have a solo 401k. So
You can't have one. Well, that's a good catch. Okay.
yeah, because you've got other employees that
Right.
you're paying a W-2 income, and it's not your spouse, so you can't have a solo 401k. So then you either need to decide, well, do I wanna pay the money to set up an actual 401k for the company, or do I it like, is the trade-off worth it? So there's a lot of considerations around paying your kids. It's it's a good tactic to use if they actually are working in the business and you're gonna be paying them
Yeah.
anyway.
So if it is a true small business in the sense that there is work, there are more people than you, that's a great thing to do. But if for the rank and file consultant sitting behind a computer every day, that sounds like an audit flag.
Mhm.
Yeah.
Yeah.
Uh,
Yeah, it's a it
one other question on that, babies can't work. Really, when we say
Oh, no.
kid, right? When we say kid,
No.
you mean how old, really, before this is a real option?
I think, and double check me on this, but I think the rule is definitely not younger than 8, and I think it's around 12 with a full job description. I mean, like, you need to be, they need to actually be working, and so I checked the labor laws in your state for the actual number on that, but
That's
I
something they can do.
def
Stuffing
yeah,
envelopes, cleaning the
yeah,
shop, right?
yeah, if you're telling me your 5-year-old is doing your books, like, I'm not in on that.
Yeah, I didn't go down the route to say that my son was our baby model, like that was just felt like,
Yeah.
yeah. All right, let's get to the fun stuff. Stage 3, you're out there killing it. All right. So now tax is a real problem. We got lots of toilets. You may even have lots of toilets now. You've made enough for some interesting investments in your lifestyle. What are you thinking now about beyond just the income and the taxation protection mechanisms we've talked about? What are the new areas that someone might want to start to bring in and consider?
So I think that this is the area where you're kind of talking about you may want to set up, especially if you're still, um, just a couple of employees, or you've got 1099 employees. It's a big business, but you don't have any W-2 income. Like a profit sharing plan might be a really good option here, because again, it can take quite a bit of that salary and kind of put it into a pre-tax vehicle. So the idea of a profit sharing plan is you can set them up concurrently with your 401k plan, but they're more of a defined benefit rather than a defined contribution plan. So they mimic the old style pensions, but you want to be careful. The reason we don't have old style pensions anymore is because they're kind of expensive, right, for the business owner. And so it isn't a tactic to use if you've got a large workforce. They're all older, and making a lot of money. That isn't a tactic to use, because you'd be paying more. But if you essentially have still, you're one or two workers younger, maybe your workers are on the younger side, like, it's a tactic to think about if you've got excess cash that you want to sock away tax free.
How does it I really don't know anything about this. So you take a pool of money from your annual profit and pull it out tax free, and then does that get invested? Does that get paid to them over time? Like, do they vest in it?
Yeah, it gets invested, and then you have to hire a TPA, which is a third party administrator, someone who kind of administrates the plan, and they do all of the testing on it to make sure your plan is right. But your money goes kind of into a pool, and then as people retire, the calculations are given as to what they are required to get for their retirement. The profit sharing part, or the defined benefit part of things.
What size benefit does this start? I mean, what size company does this start to make sense for?
One that's making a lot of money, that they, like I said, I think that the important part is the amount of people you have working for you. And it makes sense if, like, I can't give you an exact amount where it's going to make sense.
Yeah, that's fine. I'm looking for like shape of the business. Like, what is it? When do you think about this? Are you at 500,000 or are you at 20 million?
Oh, yeah, no. Yeah, like, 500,000, if you're not using it to fund the bit, if you've got a lot of profit and you wanna save it to spend later and kind of grow that tax-free savings in a way that isn't costing you money in taxes today, the profit sharing is a really good option for that.
It is a principal investment for the company.
We
You're
kind
going to invest it and take a float off of it.
Well, you're gonna invest it today, and then you get it back during your retirement.
Okay. You and your employees.
And your employees, yes, which is why, the way they do the calculations, you wanna make sure that it's probably more beneficial if you have younger employees or very few employees, because you have to be fair with all of these
Yeah.
plans. You have to be fair. So you gotta make sure that you're, you're thinking of that. And the other thing, this is another time as your business is growing where you need to, I really think that you're making a difference in this world. Your business is making a difference in this world. And if you don't have a 401k plan to help your employees grow, if you do have a lot of employees, this is a really great stage to start thinking about that. You can set them up so that you, as the business owner, get a lot of benefit out of that, but it also benefits those employees, because you want them to save. You want them to have this at this stage, at stage 3 of your business, you want your employees to grow and get better and have a good life.
Yeah.
So
Well,
so
you want to attract and retain good talent, and you have to do that, especially if we're talking about consulting and advisory businesses. Like, these are all, intellectual workers. You want good ones. You have to pay just like any other business would, and they expect, like good
Mhm.
benefits as you would
Yeah.
expect. It's the same.
Yeah, and I love that. Like, I love this stage of the business where you're starting to get employees, it's starting to grow, and you do that, your first K plan. So you change off of your solo. Now you're going to set up a plan with a 401k where they have the Roth and the after tax or the pre tax and the Roth option. There's lots of different structures that you can set up. And I would just highly recommend, again, a 401k advisor, because there are a lot of rules that you are not aware of as a business owner. You're busy making widgets and gadgets and things and serve, providing services and growing stuff. Your job is not to understand the ins and outs of every single K decision. That is why you need your team.
Yes, I agree. How did you get into doing this? I jumped right into the meat and like never asked about the bread. Like, how did you learn so much?
Yeah, it's so interesting. I love that you asked. So I actually I had 5 kids really young. We started having kids right after college. And so I was at home with my kids for the first probably 10 years of their life. About the time my youngest went to kindergarten, my oldest 3 were boys, and they started eating me out of house and home. Do not know if you have had any experience with teenage boys, but you cannot keep their stomachs fed. They're just so hungry. So I'm like, well, I guess I better go get a job. And so I did. I went out and was looking for a job. I was not looking for my calling in life. I find it really interesting that I just wanted a paycheck. Like I wasn't interested in finding my purpose. And I stumbled into financial services. I was a secretary at a small financial services firm in South Denver, and I loved it. I didn't even know this was a thing that you could do with your life. And I was hooked. It took about 2 months to realize that this was my purpose. This was my calling. I didn't realize that you could help structure people's lives and people's businesses so that they could really, with their little, comparatively, like they're not these huge millionaires most of the time, but they can do exactly the same things that these huge companies and mega conglomerates and millionaires can do. They can invest, they can make plans for their dreams, they can make their dreams come through, they can grow their businesses. It was truly my calling. So started getting all the designations.
Yeah, I think it's amazing. I think it's like such a important, first of all, I just want to reflect on this for a second as we wrap up. I think there's so many, let's use the word intricacies and how this works, that unless you have committed to the study of it, you cannot know it. That's point one. Point two is I kind of lose perspective on this because of the work that I do, the fact that we work in structuring growth and financials, and I'm reasonably quantitative. I have an MBA. Not that I naturally, but like I have enough experience to understand things like compound interest and the
Mhm.
impact of saving now versus later, and how taxation impacts you. What I've learned in my hundred or so conversations is that that's actually really unique, and that most people coming out of a corporate job know their function, but they don't know finance, let alone personal finance. And as a business owner, it's very, very, I think it's really frightening for people. And I think the other piece is like, it is very difficult to find a good advisor you trust. So I really appreciate you coming and taking the time to share all of this with the group today. I'll close us out. If we want to reach Lorie Jones is the founder of Fearless Financial Advisors. We'll put all your information in the show notes, but how should people reach out to you?
So there's a contact me on my website, fearlessfinancialadvisors.com. I'm on LinkedIn all the time, and my podcast. I do the Fearless Females podcast where I interview successful professional women and get their crazy great stories about how they got to be so impressive. And that's on my website as well. So you can
Awesome.
reach out
Yeah,
easily.
just a plug for that. Like if any of you ladies listening, you feel like you need a friend, just turn it on in your car and you'll feel like you heard your friend talk. It's the coolest thing. It's like, I felt the same way when I joined Chief, which at first I was like, I don't know, I'm gonna do this. But the benefit out of it has been there are other people like me. Like it's just I'm not the only one. It's so nice to not be on an island. So Lorie,
Yeah.
thank you again for spending the time with me today. You've been great and so much information. Thanks.
Well, thank you so much for letting me join and talk about my very favorite subject for like 45 minutes. That's the best ever.
All right. Have a great weekend. Thank you.